Can you guys hear me okay?
Yes.
Okay. I did manage to mute the speaker on the computer, so we're set.
Okay. Well, I'm going to get us kicked off here in a way that will make Margaret Darby like me again, as well as just set new precedent by remembering all on my own to read the motion here for an electronic meeting today. So to get us kicked off, I would move that due to the COVID-19 pandemic, it is necessary to hold this meeting by electronic means to protect the health and safety of the members of the committee, the consultants, staff, and members of the public. So do we have a second?
I second.
Second.
Second. And we'll do a roll call vote. I know we're required to. So Dr. Bailey?
Stephanie Bailey, yes.
And Christine Bradley?
Christine Bradley, yes.
And Tom Curtis?
Tom Curtis, yes. And again, I apologize, everybody. My camera doesn't work, so I'll hopefully get it fixed here soon. Thank you.
Kevin Crumbo is a yes. So the motion passes unanimously. And this is an easier one for me because I inquired yesterday of Michelle Bosch about a few preparatory things. And she said, Kevin, all I really need you to do is open this meeting and I'm going to take it from there. And so, Michelle, take it away.
And as I note, 85 minutes. Whoa.
Hopefully she will be able to shorten that for us.
I will not be speaking for 85 minutes.
I will only be listening for 60 because I get to chair the audit committee at the top of the next hour.
Yeah, I'm a little ADD myself.
We will do our best to go through the presentation swiftly.
All right, Michelle, you're on.
Thank you. Hi, everybody. This is Michelle Bosch speaking. I wanted to go through this meeting. Essentially, let's see, can you see my screen now?
If you could enhance it, Michelle, I don't know, putting on slideshow would make it large. I did go through the PowerPoint, and thank you for sending it so I could, but as big as you can make it on here would be great.
I think you have to click on view.
Yeah, it's not helping. So
Then please don't let
and
it
then
delay.
the reading view.
So every once in a while, the video, I'm going to stop the video, see if it adds anything to it.
mine is doing the same today. So
Looks good now.
okay, so you can see my screen now. So this agenda is basically the same agenda you just saw on the screen that Caitlin put together for us. And so our goal here today is to discuss the management of the pension fund and its investments, the investment policy statement as it stands now, and as we hope to update it based on your preferences, and also discuss some of the strategic goals and how they're aligned with our strategy. So I will take over the first part of the presentation, and then I'm hoping that I can pause after every slide and you can share with me what your opinion is. As a committee or as an individual, this will help me put together a draft investment policy statement for you that we will present to you in the coming months as a revision to the investment policy. Subsequently, you'll also see a review that is going to focus on, and it's really to give you a perspective as to the decision-making process in terms of particular managers that we're reviewing. So first, I wanted to give you kind of like a big picture. As an investment manager, we really see our ability to take risk as a three-pronged approach. The first prong is your ability to take risk, obviously, and that pertains to the pension itself and the status of Metro as a sponsor. You know, if you see here, you'll see the average age of the employees in their mid-40s, which tells you that you have a long time horizon. You have about 20 years until you start needing to pay some of these individuals. So that is a good sign that you have more ability to take risk as a pension, just because the time horizon is longer. Another prong to the risk is the need to take the risk. You know, we have about $4 billion in assets. Obviously, we have a need to reduce disbursements in the $180 million a year range. And we also have a need to earn 7.25% per year to maintain the asset level where it is so that we can pay pensioners in perpetuity. The last prong to risk is tolerance. And that's what I'm hoping that you guys can help me put together, is come up with what's, we know what our ability to take risk, we know what our need is, and now I need to understand what your tolerance for risk is. And that will go into the risk return constraints that we will put into the investment policy to better direct body and Keith in their investment process going forward. This slide was pulled from the our actuary report that was presented to the pension board in February, just to give you kind of an idea on the stats for the pensioners. This is another indication of your ability to take risk, because you have about 9,000 pensioners that were paying, that were actively paying. In turn, we have about 10,500 employees. So that's a good ratio to say that half of your half of the individuals are employees that have a long-term horizon until retirement, and half of them are pensioners that are currently receiving benefits. That also speaks to your ability to take risk, because you don't have an extraordinarily large amount of pensioners compared to employees. From what I understand, if you look back at the history, a few years back, you had maybe 6,000 pensioners and 11,000 employees, and that has leveled off to a more even sort of half and half number. And that's probably a product of, you know, the baby boomers and them retiring. So presumably now that most of the baby boomers are on that later starting to retire stage, we should have that percentage leveled off. So we feel pretty good about our ability to take risk because the fund is well funded, the pension fund is well funded, and the statistics for the population are favorable. So this is where we move into the need part. And as a committee, you have to figure out where on this pool of assets do you want your investment manager to focus on so that we can get to that need of 7.25%, to that need of being able to disperse $180 million a year in benefits, to the need of having to pay fees and expenses to run the pension, not only from the investment side, but also from the HR side with salaries and benefits, et cetera. And this is essentially generally the pool of assets or the universe that we can pick out of. And you know, we have a lot of growth assets, and naturally they're just, you know, and alternative assets as well. But this is where you would look at this sort of list and think, okay, well, this is useful. I'm happy being in real estate. I'm not happy being in timberland. It's not something I'm interested in. I'm happy putting funds into venture capital for private investments. I'm not so happy about purchasing hedge funds or commodities. Whatever this slide is meant for you to kind of soak in these different asset classes and consider them on a holistic level, not just individually, but so that if there's anything out here that pops out at you, that you communicate to us, so that we can incorporate that into how the risk profile shapes up. So when we talk about need, the biggest function on that risk perspective is your strategy allocation.
Hey, Michelle?
Yes.
Yeah. I'm not sure when I ask questions or whatever. So,
No, go ahead, please.
so under the growth assets in the last slide, is that slide, when you say domestic equities, is your wording by capitalization or factor investing? But there are two ways to approach investing or looking at something. It's two ways to analyze something. Are you just saying we go by both ways, or we go mostly by I'm not sure why those are there.
Sure. Well, just because there's different. So, for example, if we're going on the road trip, you are the committee member, you got to tell us we're driving to Florida and it's going to be 600 miles. You have, X amount of dollars to get there. So it would be Fadi's decision to decide if he's going to take Route 75 or if he's going to take Route 10. If he's going to go 55 miles an hour or if he's going to go 35 and take the back roads. And so that's essentially what this is. This is once you tell us, hey, we want to do domestic equities, we want to make sure we're focusing on that 7.25% as a target. Then Fadi can say, okay, well, the market right now, it's really favoring beta investing, or it's really favoring large caps. And that's where this sets in. He can start honing down on, okay, well, we're going to, for now, focus on large cap.
I guess the question is under domestic equities, those are two ways to look at domestic equities. By capitalization or by factors, right? As opposed to everything else, it's like everything else is a definition as opposed to a way to analyze it.
Yeah, different sorting, I would say. Different ways to kind of sort them into different buckets.
Yeah, I'll jump in real quick. So, I mean, Christine, your question. So, most of what we're doing now is by capitalization, as in kind of market cap. So, tricky because there's a blend here. So, Champlain or some other managers may look at certain factors like a momentum factor or something like that as part of their process. But in general, I think where you get the difference is capitalization is, the S&P is a market cap weighted index.
Right.
So the bigger Apple gets, the bigger Microsoft gets, they become a bigger part of the index. So there's some questions around, is that the proper way to do it? Can you do equally weighted? Or instead of looking at market cap, should we look at, some firms will look at sales, earnings, and reweight the index that way, and that's how they kind of balance it out. But so the factor is broadly defined. Quality is a factor. So all of your managers, like William Blair, like I mentioned Champlain, they're going to have a quality bias or quality factor to them. So the lines blur a little bit there. But I think this definition is just, should you go against the traditional market cap weighting, or should you look at different factors besides how much of the index weight they are? I think that's what this is saying. But
Thanks, okay.
And so to tie in Michelle's point, so are we to give guidance about how you decide to use either of those, or do they relegate to you and Fadi?
So essentially, ideally, the way the pension management should work is that you as a governing body of the pension assets, you should direct us in terms of which asset classes you would like to dive into. And that would mean, domestic equities, global equities, private equity. It should be on Fadi and the rest of the management team to focus on the specifics of how we get there apart. You give us a direction, and then it'll be on the investment manager to lead us there. Assuming we have well-described constraints into the policy, that's all that you should have to do. And then we should be able to abide by what's written in the policy to move forward. And so the idea behind this essentially is that, so when we come to you, hey, here's a new manager, there should be no question as to where does it fit, why are we looking at this? Because our directive will be clear, will be a little bit clearer and defined. But feel free to stop me because that's the idea. I want to make sure that we have a dialogue here so that I can keep notes and use the information that we're discussing to provide a better product. So right now, the asset allocation that we have in our setup or that we're using, whether consciously or unconsciously, is the asset only approach. And I don't mean that unconsciously from Keith and Fadi's point of view. They obviously know what they're doing. I mean, in terms of it's not written in the investment policy, which strategic asset allocation approach we're using. So by default, it's being on the risk tolerance approach, which means basically we're focusing on, making that return of 7.25%. We're focused on making sure we have liquidity to provide the cash that we need for each month that we make payments. And that's it. The problem that I have here is that that's not explicit in the investment policy. If you look at the investment policy in terms of goals and target, nowhere on there does it say we're looking to make what the actuary is telling us to make. We're looking to beat the benchmark of X amount, regardless of whether the benchmark is 0 or 100. So that's where we need to add clarity to the investment policy. The other approach that is a more traditional approach for pensions, particularly a more risk-averse approach, is to use that asset liability management approach, where we not only focus on the 7.25%, but we also focus on the longer-term view of the portfolio so that we can pay in perpetuity and so that we do line up our liabilities and say, we're paying 180 million a year on benefits. Is our portfolio lined up so that in 5 years we can make that payment? In 10 years, are we going to have the liquidity to provide that payment as it grows exponentially? Because we've had record levels, low inflation doesn't mean that that's going to be the case in 5 or 10 years. So again, as a risk manager, I'm looking at this on how do we protect ourselves in the future. Things are going great now, but the asset liability management approach is more risk averse and typically used by a fund that might be under 80% funded, because they have to be more strategic about where they place their monies. But again, there's a large argument for following that approach versus the asset only approach. Does the committee here have any opinion on which approach is used and or a preference?
I don't know what people think about it. So we do with our clients, we work when we've come in typically. So the asset only approach is when we'll come in every year or 18 months, whatever, and give you kind of our capital markets outlook and say, here's your targets, here's your risk return. That's pretty much the asset only approach to it. Public funds, typically every 5 years or so, maybe 4 years, you folks may want to do an asset liability study. So you're going to marry kind of this asset approach to how these assets going to look and what your liability profile looks over time, and kind of marry those out. It gets a little bit more intense when you have either a mature or a plan that's closed and you're having a bigger drawdown, and then you got to really make sure that your asset approach is matching your liability. So as your liabilities or your payouts go up, you probably don't want to be taking on as much, say, equity risk or liquidity risk. You want to be more of a fixed income profile because you're paying out more, as you get more retirees relative to active. You guys are about 50-50. So we do this type of both approaches, I guess, per se. People will look at the asset liability approach every 5 years, and that usually goes hand in hand if you work through actuary and you do actuarial studies. So they'll look how fast or slow people are dying, kind of what the inflation looks like, are you hiring, or in Nashville's case, you're clearly hiring, employees are going up, salaries, that all flows into the liability aspect of it. So 2 ways to approach it. But you can look at both.
They're not mutually exclusive of each
Right,
other.
right.
I mean,
No.
we've done asset liability studies, probably a couple of them in the last 10 years. And we also do on the Bear One actually has a module for that. And we upload the information from, it has not been, I think what Michelle's point is, I believe is what I'm understanding, it has not been articulated in our investment policy though.
Great. And that's what my portion of the presentation is trying to cover. So I just wanted to make that clear.
I just have a question for Keith. When you review that on a yearly basis, kind of the asset liability sort of approach, when you review that way, do you do that net of fees?
So, well, let me step back. So we don't do asset and liabilities every year. That's typically like a 4 or 5 year thing. The asset approach is, and then we make the assumption that they are net of fees. So for example, we're going to say the U.S. large cap is going to earn 5%. We say that's net of fees. That's our assumption. And that's beta only. So beta means the market's going to give you 5, you get 5. It doesn't say you're going to hire a great manager and you're going to outperform or underperform. Typically, theoretically, you should outperform your managers. In this case, PIMCO had a great 2020. I mean, you can't expect 20+% outperformance, but maybe 50 basis points or extra there. So yes, net of fees, but the AL, like I said, the liabilities don't move around that much unless you have a dramatic change in the plan per se. So whether it's hiring or COLAs or salaries or interest rates, unless some of that changes, that's when your liabilities will, or if you change your discount rate, if you went from 7.25 to 6.25, your liabilities will go up probably 10-12% overnight. So that's when that's typically when you'll run that study every 5 years, or when you make a big change to the assumptions that hit the liability side of things. Hopefully that answers it.
This affects how we set up the portfolio because our liabilities would be more employees. More employees would mean essentially not just for us, but higher GDP overall for the United States. Higher GDP means stocks are essentially rising because the stock market is tied to GDP. So then that would shift your portfolio towards more stock heavy. So that's the thought process about picking an approach, or if you don't pick one, just say, okay, well maybe we'll do a little bit of both. But we'll definitely look at both approaches as necessary, and that's something we can allude to in the policy. I just want to make sure that it gets addressed in terms of how we're looking at the asset allocation. So academically, I think you can read any white paper will argue that asset allocation is the single most important part of an investment decision, which is why that asset allocation piece is assigned to you as a committee. And then it will be Fadi and Keith's responsibility to execute that, whether it's with stock A or stock B or manager X or manager Y. The manager name and title and background should be, it's Fadi's job. He'll figure it out if it's a good one. So long as he has the correct directive, then you should get there. And this is what research says. You should get there regardless. Whether Fadi's an amazing manager or whether he's mediocre, you should still get there, assuming you have the right asset allocation for the portfolio. This is no dig on anybody. This is just, historically how it has worked out for investments, which is why us as investment managers focus so much on asset allocation. This graph here shows a 5-year projection of kind of like where return and volatility lie for different asset classes. This is a report that we got from PIMCO, and volatility is sort of a subset of sigma, which is your standard deviation or your measure of risk. So based on where you set up your asset allocation will tell us which items to pick out of, okay, where do we want to be in The private equity, we know we're going to have higher risk, but it's going to give us that higher return, and we have a higher tolerance for risk. So we're comfortable doing that. Or do we want to stick with mortgage-backed securities, which is, on the lower end of the volatility scale, but also on the return side. And so here's where we get to the nitty-gritty, and this is the current ranges that we have in the investment policy here on the first percentage column. The targets that are currently set are in the middle, and these targets are Fadi and Keith kind of getting together, using some of the tools that we have from MS. I'm trying to blend. Some of the tools that we have to help us find the proper allocation mix or target mix. And then here's on the far right are the current percentages as of the last report, which was 12/31/20. The reason I want to look at these ranges with you all is because I want to discuss the possibility of modifying these numbers. As a for example, you can see that we're out of compliance for the policy range on private equity. So I know that we're kind of, we produce a domestic equity percentage to accommodate so that we're still in line on a total equity basis, percentage-wise. But we know that private equity is a kind of a long-term investment. So we need to look into modifying that policy range, because we're not going to come out of that 20, double digit in the next year, right? Which means we don't have much flexibility on the domestic equity side for movement, because for example, if you're taking 7% from the domestic equity to put it into private equity, now we've reduced our ability to invest in domestic equity. And should the opportunity arise, we want to make sure we have that flexibility to get back into domestic equity. So again, I'm putting this on the floor. I wanted to have your thoughts about what you think about what we're doing here. What do we do for exceptions when we have exceptions like this, when we go outside of policy ranges? Do you have any reporting requirements? Any of that kind of input would be useful here.
Yeah, well, this is Tom. My thinking is that a lot of our private equity, and Keith, you can tell me, or Fatty, that a lot of the private equity over allocation at this point is from very good appreciation of the asset and performance. So when I look at, the equities all told, it seems like, yeah, I mean, we certainly appear to have kind of cut our domestic equity allocation to keep equities in general in balance. But I mean, the private equity, I think that's good news, is it not, from a performance standpoint?
Right.
Yeah, so we know that. Sorry, I was just.
All right, go ahead.
And so when we do the executive, so we note on the executive summary, we do know, and I think I pretty much speak to, each quarter we say, hey, the one asset class that is out of range is private equity. A lot of that, to your point, Tom, is being driven by good performance. Now, there were some allocations a handful of years back, so those are starting to pay off, and that kind of drove it up there. But we do note, and since we came on board, we noted it was over target. So we've been managing, we've slowed those pacing plans down a little bit. So yeah, we've managed to a 12% target, but we're assuming, I don't know off the top of my head, but we're assuming very little net growth in the plan. I think maybe 2 or 3% or whatever it is. We're not assuming that the plan is going to grow the 7.25 target. If we did that, we'd be putting a lot more in private equity, private markets in general. So we've been trying to slow roll it. The point, it just takes time for these to unwind, to get your distributions back. You don't want to just stop and not, invest in private markets, because you don't know when a good or bad vintage year is. And then two, it's not domestic where you can just say, push the sell button and say, okay, let's liquidate, a couple percentage there. You could, if you want to go to secondary market, but then you're going to be, losing some of your value there. So we're managing to it. But for instance, Greenspring and some of the VC funds have done really well. So even though we've been lowering that pace over the last, 3-4 years, the valuations are kind of keeping up with that lower pacing. And then, you know, as distributions come back, that'll come down, and then that could be used to fund existing investments, move into domestic equity, fund benefits, and so forth there. But we do note that it is out of range. You could change the range and put you back in the policy, but you're limited to what you can do around changing that current allocation.
Right, and that's what we're trying to do here, is trying to figure out, well, our new numbers, let's say 20%. And we're comfortable with the private equity, and, you know, we're happy with what it's doing, but then we need to change our policy range so that it matches more with what we're allowing and what we would like to see out of the portfolio.
Hey, Michelle, this is Christine. So I'm just trying to understand, do we need to change the range, or do we need to simply keep within, because when you go to the tactical asset allocation, the max we should be is 20%, and we're at 22. So is the range okay, and just our management of that range maybe needs adjusting?
So that's for you to tell us. If you're okay with that range, then we do need to manage our current position. And what Keith said is that we are doing just that. Having said that, you know, you don't get from 12% to get to 22 overnight. So we need to manage it a little bit closer. And so my understanding is that everybody's comfortable with the level of private equity. And if that's the case, then I'm recommending we modify the policy.
Yeah, it would seem to me that if you're getting the proper, and it's a big if, the proper premium for the illiquidity, that the private equity kind of is a good allocation to have, I think. But Keith, what are the statistics on the percentage of the equity market now that is private versus publicly traded? Because that's increased over time, has it not?
Yeah, I don't have that number off the top of my head, but there's probably only between 3,000 and 4,000 public companies, maybe 30, let's just call it 3,500, from, you know, 5,000+, probably 5-10 years ago. So yeah, more and more are going or have gone private. And then in general, you know, the ones that do come public are staying private longer, which is why I think you're seeing, you know, some more dramatic results. So they're staying private, and even some of your managers on the public markets have the ability to invest in some of these too. But yeah, the public markets have shrunk over time.
Well, I think theoretically, you know, we've always heard that these people that have to manage to the public markets and make very short-term decisions aren't necessarily the best way to go, just generically speaking. So it does seem that the market has kind of gravitated that way over the last several decades to say, if it's private, you might be able to get a better return. And to me, if we're with managers that are giving us some kind of a reasonable premium for illiquidity, and we have the runway to look at our liabilities out there, nothing, which we do. It's part of the studies that we get every 5 years or so, and try to understand those, that, you know, the liquidity portion of our portfolio seems to be fairly adequate to me. It's just a matter of, you know, it's just wonderful private equity companies that are large, that to me, the risk is they're private, but that to me is also an advantage to them as well. So, you know, to me, I would think a larger policy range for that to accommodate that kind of what seems to be a fairly, I won't say permanent, but seems to be somewhat of a permanent change in the mix between private and public equities, and the need to be in the private side to get the additional return relative to the publicly traded stocks. Just a thought there.
Okay. That's my thought too. So I'll come back with some drafts for you to review on the ranges once I propose to do
Okay.
that.
Thanks.
So what Christina's talking about now is that tactical asset allocation, and this goes into the more tolerance, and this is more of the committee's tolerance on risk. And this subject matter is not addressed in the investment policy. We are doing this as a matter of practical matter. When Fadi sees an opportunity in the market, he jumps in, we make a ton of money, and it works out. Having said that, we do need to add some restraints. We can't just, expect that in 20 years, Fadi is receiving the benefits of the pension and who's ever managing decides that he wants to put everything in commodities. Well, this is where you control for that. So putting a tactical asset allocation into the policy gives the investment manager restraint in terms of, okay, well, you can't just jump in head first. It's always methodical, but this just helps to give a little bit more of the risk management perspective to your tolerance. The 5 to 10% ratio range is what's typically accepted for tactical asset allocation, and I've put in some recommendations that I will add to the investment policy on this table here, unless you have any discussion or items you'd like to change.
This is Tom again. From your experience, Michelle, you clearly feel, I guess, that 5 to 10% is enough so that you can react to your intuition and expertise to go ahead and make some tactical allocations between meetings, right? So you don't have to wait on us to do that, and that's plenty of room.
Yes.
Okay, good.
Yeah, I mean, the idea is that we don't buy 50% of, Apple because we spend $2 billion on it.
Right.
I know it sounds ridiculous, but, a pandemic also sounded ridiculous 10 years ago. So just wanted to make sure it's in writing. So these are the recommended levels.
Yeah.
And they're my recommendations based on cost of execution. As you might imagine, it's very easy to buy and sell cash. So that's why it would be easier for Fadi to move in and out of cash type assets than something like a hedge fund. So.
Yep.
Okay, so I put this slide here for you all, the committee, and I would like for you, when our meeting is over, to kind of go through the questions and make sure that, in your heart, you can answer these and feel absolutely confident that you know the answer and you know the direction that we're going. And I'm saying that as sternly as I can, because this is your responsibility to guide us so that we can set up the portfolio as you want to see it, as it will benefit, the pensioners, all of the retired police, and everybody that's sitting here working, that's going to be receiving benefits in the next 15 to 20 years. If we're not there, then we need to have a discussion, and I'm happy to do that individually because we're running out of time. So I just wanted to let you know that I implore you to review these questions that I've written here, see how you feel about them, and then let's have a chat about them after this meeting. These are some of the risk and return objectives that I pulled from our current investment policy. As you can see here, our policy says, we would like to meet or exceed our benchmark as a general focus. If you want to go with the asset management approach, then we need to indicate on here that we are interested in trying to reach the target. I mean, it doesn't, we don't want to pinhole our objectives into that 7.25%, but I think it needs to be explicit that that is part of our goal to meet the minimum requirement so that we can keep the fund going in perpetuity. And that's also something that we need to put into the objectives in writing, is our goal to get the assets to continue to perpetuity for our benefits. And then, in kind, on the constraint side, we need to discuss in general, how do we feel about different companies? How do we feel about different countries? How do we feel about some of the different types of constraints that we can put on the portfolio that leave you awake at night, that sort of thing. And I'll be working on putting these constraints and objectives together to revise our policy. So if you, after you reviewed the previous page on fiduciary duties, if you think of other constraints that are important to you and that are important to the committee, then please pass those along to me so that I can incorporate them and then we can work through them in the draft documents. So lastly, I'll go through the ESG portion. This is something I'm also looking to add to the policy, and it's covering environmental, social, and corporate governance. If you do research on companies and read books like, From Good to Great and other things, books like that, it always comes down to governance. Great companies have great governance structures. And that's where I focus my investments, and that's where I always recommend that if you do any ESG investments, that you focus on that. There's a school of thought that believes that ESG investments are not worthwhile, but if you're a long-term investor, like the pension is, it is something to consider. There's different ways that we can look at ESG. In particularly, are we looking for a positive screening, which in this case, we're saying, okay, well, no companies that has child labor in China, we're not going to buy any of their stocks. Or if you do a negative screening, which is what we consider a more practical approach, we're saying, okay, well, if 20% of their revenue comes from firearm, that's fine, because it's fine. If it's 80% of the revenue comes from firearm sales, then I'm not interested in buying that stock. That's what negative screening would look like. So if we care to incorporate ESG into the portfolio and into the investment policy, I'll add a note to the policy alluding to that, and then we can provide more directive to Fadi and Keith from there.
Michelle, at some point, this is Christine, I'd love a deeper conversation about that, because there's a few years back, Fadi will remember, we elected to go with a company that was doing some fracking, and we probably made some money, but at the time it felt it felt not okay to me. But on the other hand, as a fiduciary responsibility to build people's dollars and to make sure that they have their pension, I was pulled. So I don't know. I'm not familiar enough with opportunities to know that, can we make our goal of 7.25% and put too many constraints on us? So I'm not asking for that answer right now. That's a tough question. I would appreciate the discussion.
Yeah, and that's where some of that, the screening type for ESG is useful, because you can have, a little bit, I'm of the opinion, for ESG, if you buy a company that is doing the right thing, eventually it will pay off, because people will buy their product, people will continue to work for them. And in the long run, your buying power will really make the decision. And, Gen Z and Gen Y are moving in that direction. So I definitely think that's a subject matter to discuss more deeply.
Yeah, I'll chime in. We have, our endowment foundation group has certainly done more of this as far as the ESG. So happy to, Chrissy Butler's a partner, happy to have her or somebody else in the group do it. Some of our West Coast clients have gotten into this a little bit more in depth as well. I'd say the G part of it is maybe more common or easier to tackle. The E and ES, the environmental and social, there's kind of varying degrees of success or not success based on certain studies, and that's been harder to tackle, because environmental and social are different amongst not only board members but the beneficiaries. Ultimately, governance is pretty much, you want good management and good governance. So that's been the easier part of it to tackle. But like I said, we've done a bunch of work at the firm level, so happy to incorporate to one of the IC meetings or a one-off meeting or whatever to dig into that. And even some of our West Coast consultants as well, if you want to do that.
Most, I think I was going to say this, but I think Keith already said it, that most public plans focus on governance because it can be done, and sustainability is another one that basically kind of do no harm kind of thing. But it is tougher for governments to make these choices because the fiduciaries, it's very clear. We can discuss the Department of Labor rules, and I think we've gone over it before. I think Margaret did a study a while back, it's been a while ago, regarding what the fiduciary duty here is. And the Department of Labor has been very clear that you have to have a clear case that this is going to make more money for the plan. And it's been tough for a lot of those other type of investments to actually make money. A lot of studies show they make less money. But governance has always been a winner as far as proving that if you have better governance, you have better outcome.
This is Margaret. I'm going to chime in here really quickly. If you go into the investment committee data room on the SharePoint file, you'll find a memo that I sent to the committee. I believe it's called Conflicts of Interest, but it has some guidance in there about the duty of loyalty to the beneficiaries of the plan. And I think that in the past that was, and Christine, you alluded to this, that when we were looking at the fracking investment, you had to weigh, the investment in fracking and all the concerns that go with the actual activity versus your duty of loyalty to the beneficiaries. So you have to make a decision, weighing those things, and the decisions that you make for your investments can't be based on your personal beliefs or your indirect or something that might be considered a conflict based on your personal beliefs. You have to look at all of the elements of the actual investment and not necessarily whether you feel that it is a good or bad action that they're taking. So unless it's something that they're doing that's illegal.
This is Tom.
I recommend that you go back and look through that memo that I sent, because it also will direct you to the Tennessee's uniform or the prudent investor statutes, which are important for the committee to be aware of and know. And there are a lot of good notations in those sections of the statutes.
Margaret, along the same vein, this is Tom. I understand and hear what you're saying. I do think we're getting more and more experience publicly, not just us, but I'm just talking about the market in general. So I do think it's a difference between what our fiduciary and I think the ethical issues certainly blend in there as well, are a huge part of it. So I do think this is a good discussion to have. I think it would be nice, as Christine had mentioned earlier, to get everybody together and actually have this discussion, because it's, we represent the ethic of the city and everything else. I'm not lecturing anybody on anything. I just think it's something necessary we need to do and look at. And I do think the governance piece is a very strong part of that. So anyway, yeah, I'll be quiet with that, but I just like to see us get together and have a special meeting to talk about it.
And the bottom line is there, and if we say that this is sort of touches all our hearts at some point, then we tell our manager, we tell Keith, we say, listen, look for other opportunities for us to make the same return on the dollar. And then you're not maybe, I don't know. That's maybe pie in the sky. So I won't say anything else.
I'll wait till we have further discussion.
Okay, good. I agree. We can't ignore it any longer. But so I'd like to pass on the presentation over to Fadi. He'd like to go over the rest of the pages. I purposely left off the portfolio statistics portion that you can peruse on your own, just in the interest of time. But we'll be able to go through the rest of the presentation if you want to start sharing.
Yeah, can you hand it back to me, or?
Yeah.
I'm not able to share yet. Oh, here we go.
Yeah, and Michelle, this is Kevin. I'll need to drop here at the top of the hour to open up the audit committee meeting. And so I'll pass the baton over to Christine, maybe to lead to a conclusion here if we're not finished by then.
That's fine, thank you. We will not be making any decisions as a committee. So this is all for information purposes only.
Okay, thank you.
Thank you, Kevin.
Yep.
Okay, can you guys see the pie chart?
Yes.
Okay, great, thank you. So I'm going to try to go through these slides pretty quickly due to the limitation on time, and I've kind of planned it out so that we would have the conclusion or the discussion would be around the last two slides. So let me see if I can go through this, but if you have any question about the slide subject, obviously, interrupt me. So what I did, primarily because Michelle had a lot of questions about the allocation of the portfolio, is I used the data that we have in our risk reports that we use with MSCI Bureau 1 to break down the assets. We have a little bit of a picture of where we are. And this is the alternative fixed income bucket that we have. It's currently, I think, around 18%. Primarily, it's divided in half between opportunistic investing and the other half in more lending. It is primarily North America, and when we say North America, it's really U.S. Canada represents a very small piece. The remainder, the second biggest chunk, is what's considered Europe, Middle East, and Africa. And again, it's really Europe, Western Europe, primarily Germany, London, UK, Germany, and France, but with scattered assets throughout. As far as the entire plan, there's very little in Middle East and Africa. We have one private equity Africa manager. The rest of the world is 7%. Asia is very small. There's really three reasons for this. One is that predominantly English law protects lenders, and this is lending. We try to limit currency exposure when hedging is expensive. And finally, our manager base is primarily in the U.S., so their platforms probably have a slight bias, but that's actually changing as they get bigger and build more capacity. Next slide. Oops. This is our private equity breakdown by region, and again, it is North America based. We have picked up quite a bit in Europe, but there's not as much opportunity in Europe, and we don't traverse in that space as much, but we have picked up some managers. We use LGT and some directs. We have a reasonable amount of Asia exposure in the private equity program, which is a little different than the previous slide, and that's primarily because of our exposure to growth, not venture capital, but growth investing in emerging markets. And so going further, next page. So this is our third alternative bucket, and it's real assets, and it is predominantly North America. And for the very same reasons I mentioned earlier, we are seeing managers do a little bit more, but for example, a lot of the commingled funds, a lot of the large funds that we use that had previously 11-12% in Asia are upping that by 10% because they've grown their footprint. But I think that this will always have some U.S. bias, at least for the foreseeable future. For the same reasons I mentioned in the first slide I went over with the legal protections and so on. So when I put together the risk assets, all the risk assets in the portfolio, so this is everything in the portfolio except for our traditional fixed income that is U.S. based for our liquidity needs. This is what the portfolio looks like. And on the left pie chart, on the right graph, I showed what the portfolio looks like in orange compared to the gray area, which is the world index. So you can see here that we're relatively, I mean, you don't have to match that exactly. So it's relatively, the only area that's kind of a little glaring difference is Asia Pacific, we don't have a lot there. And when you total up all the assets, just because there's so little in real assets and fixed income alternatives. If I added the fixed income here, what you would see is that the North America would go to about 77% because our fixed income is U.S. based, and it's that way for a reason. It's our liquidity, it's our safe assets. That's really the conclusion of the breakdown of the portfolio. I'm going to change over now to talking about China. China is an interesting topic, and I know it's in the news, and so I was hoping to take a stab at this and look at sort of why the opportunity is there and what are some of the issues. As you can see here from the slide, we're talking about a population of 1.4 billion people. It's a lot. The retail sales alone in China equals $6 trillion. The GDP per capita is skyrocketing. It's still low relative to Western standards, but it's growing very rapidly. And they are the largest economy, second largest economy in the world. China joined the World Trade Organization in 2001. But this, I found a statistic. I got most of these slides from some of our managers during their annual presentation. They have been growing tremendously relative to the rest of the world. And this growth is likely to continue over the next 20, maybe 30 years, but they've got some ways to go based on population. We saw something similar to this in the U.S. after World War II. A lot of similarities. So this is there's a group of people in China that are referred to in China as the young free spenders. In our world, we call them millennials, and they are a growing part of the spending. And the light gray, the lighter of the grays on your screen, represents the growth. So they basically, surveyed young free spenders and said, are you spending more or less on the following products? And you can see the light gray, these are the people that increase their spending by more than 5% on these categories. And these categories are normal consumable items that, for the most part. So the sales, domestic consumption is a recurring story. And this slide just demonstrates that there is a lot of room to go. If you look at, China is represented by that circle on the left, and you look at the United States and Europe. So household consumption could move to the right considerably. The moving vertical is how much reliant you are on exports. So they are forming a considerable domestic economy, but it still has a long ways to go. Again, showing their power in the consumption area. They are relative to 2000 to 2005, which represents the information on the left. They've grown from 9% of the world's consumption basically to 23 just in that time frame. And again, their population is 1.4 billion. Ours is 350 million. So you can see how much more growth they can have when 350 million people are consuming 27%. The young spenders are flexing their muscle. You can see it all over their economy. And just to put it into size perspective, the baby boomers at their peak represented 78 million people in America. And that they had a profound effect on the American economy, and some would argue the global economy. Millennials in the U.S. It represents 70 million. It's like 70.1 million is the size of that population in the U.S. So it's a significant population, but smaller than obviously the boomers were. To put it in perspective again, that there are 350 million millennials. And they are flexing their power. You see the consumption here, and Tiffany's and Tesla and what you might have. And there's a lot of formation of new brands for them that cater to their needs, whether it's for, where they're working, they're eating, the transportation, you name it. People, companies are being formed to cater to those needs. So this kind of touches a little bit on maybe Tom's question in an indirect way. So in 1990, China was basically 0% of global venture capital dollars. The United States was 92%. Today, the United States is 49% of that, with China representing 21%. And based on that 1.4 billion population, that number has room to grow. So a lot of political issues. If you look at various let's say the Wall Street Journal represents the U.S., you can see that, they outline often the unfair trade practices, human rights abuses. And granted, there are issues. They definitely, as a society, have a lot of things to fix. And I think much like the United States did in 1950, we weren't perfect either. And, from their perspective, they look at us as basically being influential in Asia, and we're basically suppressing their aspirations. And this slide was put together by a Chinese manager, right? Not a Chinese manager, by a Singapore-based manager. So they're always very. But bottom line, I think honestly they feel like they're surrounded by military bases from the U.S. So that's that's kind of listening to both sides. So the U.S. has taken a lot of action, starting with, I think, the Trump administration, against Huey and others. And quite frankly, in a lot of cases, we have not seen a response from China. They've been pretty muted overall. Even when they sanctioned, so when we took some action against Politburo members, they ended up. This is in the middle of COVID. They prohibited Marco Rubio and Ted Cruz from traveling to China, but no American could travel to China during that time frame. So they're trying to kind of manage their way through it. And the reason they're trying to manage their way through it and it is really this. This is prior to COVID. This picture is from 2018. This is a job fair in the Hebei province of China. And you can see the sheer number of people that they still have to find jobs for, and that's where why their policies are what they are, and the world is starting the world's starting to respond by asking for moderation on some of these things and addressing some of the issues around the labor practices. I think in this slide just demonstrate how a lot of their trade routes are actually influenced by the U.S. So there's an idea out. There's a lot of ideas out there how this could resolve itself and how long it would take. And I don't have enough time to go, detail into that. However, there's a big idea that seems to be kind of how things are falling, which is the idea of decoupling, and that is that essentially the U.S. and the Western world will manage its supply chain to its benefit and not be reliant totally on China, and China will do the same. They are doing the same. On the other hand, they will cooperate with each other where it's mutually beneficial. And how this actually plays out will take years to unravel, just like trade between Europe and the U.S. did after World War I. But this scenario, reason I want to focus on it, is that this is not a negative scenario for a U.S.-based pension plan. Because if we have a supply chain that's more sustainable, that would generally mean more jobs in our country and trading partners. At the same time, if there are areas of strategic importance for both and there's cooperation, then that might mean more trade in certain sectors. And I don't know what's going to happen, but I'm just simply speculating on how these things work out over time. Now, what we do know is that China is very friendly to foreign capital and has continued to do, and the reason they are this way is because of the picture I showed you earlier. They have jobs to create, and this is investment money that comes from the outside and creates these opportunities. Reforms. There's been many in China. They don't often get reported unless you're into reading on this stuff on a daily basis. But certainly, there are a lot of financial reforms and not many social reforms, and that could have been said about the West at one time in our history, but we've come a long way from that. And this goes back to that decoupling, and where there's areas of cooperation, areas of they want to produce as much of the product they consume as possible, but they do want some services and some. So they are signaling gradually over time on what sectors they're willing to use these laws that the U.S. and other countries use for fair trade and so on, and what sectors they want to keep for themselves. This is going to be a long negotiating process, and I think that both the United States and China are going to have a hard time with this, because the United States is used to being the world leader for many years and dictating these things, representing Western standards, and China is like the new player on the block. And I think Henry Kissinger has pointed out on a few occasions that we're not really used to that, and it's going to take us some time to adjust. But in the grand scheme of things, it's really still early in the game. This is foreign participation in various countries. You can see China is very small, and we're likely to hear of more issues, not less issues with China, because these things some of them have been around. Some of these issues have been around for a long time, but some are just now becoming to light or being reported on widely. They are continuing to grow and issue more IPOs. They issued IPOs in the middle of COVID pandemic. Why? Because they know that that's funding for their jobs. The valuations in their market is some of the lowest valuations in the world. You can buy companies cheaper there than anywhere in the world. For various reasons, but the biggest reason is that the older generation has put all of their money and a lot of the governments have financed real estate, and so the money has all gone into real estate. They had a huge real estate bubble, but those 350 million young free spenders, they're actually starting to invest in stocks on apps on their phone. And I think this is going to have a tremendous change to the market valuations, just like the baby boomers, as they started to save for retirement, changed valuations in the United States. So generally speaking, and I don't want to get too much into strategy, but I've often said this before when we talked about investing in China, is that one, we're trying to avoid sectors that are dependent on export because it's vulnerable to these trade issues, and that's going to continue to be the case. And also, there are politically sensitive sectors. Just like, we have industries here that are regulated. FCC regulates a lot of things. SEC regulates different areas. So, they have their own way of regulating things. It is not what we would think of as regulating, but, state media and communications is a big part of their focus because that's how they maintain social order. Instead, we focus on consumption, domestic demand, and quite frankly, we represent some of the best companies there because foreign investors usually do have better hiring practices. So this shows some of the large companies in the U.S. on the right, and then China on the left, and basically they represent billions of dollars on both sides. However, it's taken these Chinese companies, these mega Chinese companies, to about 5.3 years to actually reach that potential. Where in the U.S., our venture capital takes more like 8 years. So this is due to the rapid growth, adoption rates, and so on, is causing a tremendous opportunity. Here we looked at unicorns, and on both sides, whether it's on the U.S. or we looked at just companies that unicorns that are sort of in the pipeline right now that are due to come out in the next few years. In China, we did not include these sectors that are sensitive, like you won't see Tencent and people like that here. These are just, companies that are basically domestic Chinese consumption companies. And you can see that we have our top handful of companies are estimated to represent $26 billion. Their top 5 is estimated at $71 billion. That just shows you how much is coming out. Now, we don't do a lot of venture capital. We have some venture capital in China, but most of ours is more growth oriented. So they do go public, they're just in a later stage. But this gives you an idea of the size of the market. So diversification benefits of investing in China, and I saw this quote and so I thought I'd share it, but a different take on this, in my opinion, but along the same line, is if a European investor was looking at the United States in 1950, they would have said that there's a lot of social problems in the U.S. in 1950. It would have been a mistake, though, not to invest, because those social problems, some of them got addressed, and some of them we are still addressing today. But at the same time, the century was definitely declared to be the U.S. century because of what the U.S. became after World War II. And finally, I don't know what to say about this one, but the penetration of private equity in China is much lower, obviously, in the United States and Europe. I showed that and demonstrated that in an earlier slide. So then I want to talk a little bit about performance. So these are not all the funds that we're in. These are actually, I got this from the managers. They're just talking about the flagship fund. We invested in number 3 and number 4, number 5 and number 6. Now, number 5 and 6 are really too early to calculate IRR. They do it, but we don't do it in our book. We have rules about how much strong they have to be before we can calculate that, but it's definitely too early. Matter of fact, number 5 is tracking to be better than number 3 or 4. It's just early in the game. So everybody has 2 funds. This is a sample. Both are returning above 18% IRR, 25 and 19. So I went back to our private equity portfolio and said, okay, how many commitments have we made that have been around long enough that we actually have a good return number for, meaning that they're older than 3 years and they're more than 50% called. That's the rule we use. And basically I came up with a number of 37. And then I looked at sort of what percentage of that 37 actually gave us an IRR of higher than 18, and that number is 30%. And then I calculated, well, what if I just remove these 2 funds? What would our batting average be? And just removing those 2 funds would bring our batting average down to 25%. So, there's a reason why venture capital and Chinese growth investment are doing well. It's demographics. That's really the driver of everything. And I intentionally did not cover all of the issues around this. I just wanted to kind of, summarize the investment thesis. But obviously, we have a very good, socially responsible investing policy from Axiom and all the managers, as a matter of fact. Happy to share that. Maybe we'll go over that in another meeting. But also, we feel like this is a good investment opportunity, and we represent the good guy in these countries. And that's true of all emerging markets, including my own home country. Non-governmental organizations, foreign companies, they are who everybody wants to work for in a lot of cases because they have better hiring standards, they have fairer standards for treating people, they give people benefits and the vacations and so on. And actually, we see that all the time, and we do review it when we talk to our managers. Even our partners, the general partners, you will see women as a portfolio manager or an actual partner at a private equity firm that's mostly has endowment investors. You will not see that with the domestic companies. I promise you. So that just gives you a little bit of insight into the Chinese story, and I do understand that. Believe me, I'm a minority from the Middle East, so I've been a minority wherever I've lived all my life. So I understand that there are social issues. I understand that these things concern us, and believe me, when I buy things, I take these things into consideration. I just don't know that, in my view, that we are actually in a position to negotiate with China. Our government is, and if the federal government decides that it's part of their strategy to not allow U.S. investors in China, we would obviously comply. I don't think that the Trump administration did do that. I doubt this administration will do that, and quite frankly, because it serves a good purpose. Our investments are part of the solution, not the problem. They need to go after those other hiring practices. Now, there are companies in the U.S., some of their products are in your hand or on your feet, that do need to be much more responsible in how they source their product. But I promise you, we don't have those kinds of issues in our portfolio because we know all the companies, we know what they do. So that's really the end of my presentation. I hope it's been informative.
Fadi, hi, this is Stephanie Bailey. I appreciate how you presented it, the balance of it. I like the historical perspective that you've given, and I truly understand your point. So I just want to congratulate you on how you put the presentation together. It was balanced. So
thank you. I appreciate that. It's a sensitive issue, I know.
Yeah, I too thank you, Pat. It was a good presentation. I'm the one, I guess, when we had at the last investment committee meeting, thought that I detected some hesitancy or some, maybe need more education on the risk in China. So this was very helpful to me. And I don't know, I'd love to hear other people's thoughts about.
I think you're on mute, Christine.
Yeah, I just wanted to say that I just thought the whole presentation, Michelle and Fadi, thank you so much. What it did is it provided the impetus for some really great discussion. You got some real good thinking out. And, to Michelle's point, I think that this also will provide us an opportunity to look at our policy, see if we want to make any changes to our policy, and an opportunity to ask questions, where Michelle pointed us to those areas that we really need to make sure we understand what the decisions we're making, why we're making them, and have a policy that backs us up. So both of you, thank you so much. And Keith, thank you for being here. This is helpful, everybody.
I have more slides on China, but I won't bring them up today. I will just say that, if you allow me 3 minutes, I'll just talk to them. When we do our capital markets outlook each year, we do major themes, and one of those major themes is China transitions. And a lot of the slides that Fadi talked about is the change from export-driven China to consumption-driven China, which is similar to the U.S., and it speaks to the growth equity in the areas that we're investing in.
Presentation, what's up?
We could cover it at another time. I know we're running late on time.
Awesome. Okay.
And then I would also add that the questions that were provided that challenged us as committee members, I looked at those. I found myself maybe not knowing the answer to 2 of them, but this certainly goes a long way to help bridge that gap And I'm thankful for the challenge of the questions that Michelle had on that slide. So, and also when Margaret mentioned about the duties of something paper that's in the SharePoint. I think that was good to point us back to that. I do have definitely opinions about investing in China. I do. I have definite ones, especially since just recently Christians have been, begin to be a part of the Uyghur group. So I do have, but I will go back and read the duties of loyalty, because just like Christine did with the fracking piece, our overall goal is for the benefit. I like the language of we're the good guys trying to cause a different sort of perspective if we were to invest. So there were several statements that were quite helpful, but I do have a strong opinion about whether we should invest in China or not. But I'm open to explore why that is for me and if I can get to another place.
Anything else from anybody?
Well, I guess, I'm wondering, I was the one that kind of, I guess, poured water last time. Christine, you had made a motion to accept the the Axios recommendation. After hearing some comments, I thought that maybe we need to revisit the risk that we felt there would be investing with China. So before I even get too much further on that thought, Fatty and Keith, is that fund still open that we turned down the other day, or have they closed that fund?
We'll have to check. I think maybe we could still at least do one of them. But honestly, I have not been pressing them to hold for us. My biggest concern really is to make sure that as a committee we get to a point where we're comfortable with what we're doing. I have a much bigger concern about when people feel like they're doing things that they shouldn't be doing, and the perceived negative impact, because I know with confidence that we're not doing negative impacts. Now, I'll admit to Christine that we may have a differing opinion of fracking, but I don't know that it's a moral issue, but I can lay out the argument for why it's been good, and you can probably lay out an equally good argument why it's not good. But I think China is a little different story, because I am highly convicted that the value of foreign investment to change things. These practices start to change from within. Let me tell you a quick little story. I used to, as a part-time volunteer back about 20 years ago, work for an advocacy group for minorities in the Middle East. Because I was spent most of my time in the U.S., I could write English decent, so I got nominated to deal with the press and the press releases and all of that. And the things that we used to do to make Saudi Arabia look bad, and how they treated women, and how Syria did and what Iran did. We used to just be as extreme as some of the people lived in D.C. and could go visit politicians in D.C. in the federal government and try to enforce these changes. And I was 100% positive that what I was doing was good. But in hindsight, as I step back, if they had followed everything we wanted to do, we would have just become the enemy of Saudi Arabia. But, Saudi Arabia is slowly coming around just because we didn't draw that line in the sand. And I don't know if that's what's going to happen with China. Maybe they will draw the line in the sand. I just want to open that conversation so that we have, as a committee, we're comfortable with these decisions. And if we miss this time around, I'm okay with it. I want to make sure that we're comfortable with what we're doing, and we understand our fiduciary duty, and also be cognizant of these issues that some committee members have concerns about.
Thanks, Fadi. And anything else, Michelle, Keith? You guys are wonderful. I appreciate you all.
Okay, very good.
Thank
Are
you.
we done? Thank you.
Thank you.
Appreciate it. Cheers.
Bye.
Thank you. Bye-bye.